Good morning, everyone, and welcome to the European crossover webinar. And we are seeing indices come back after the slide that was actually induced by the hard liquidation in gold. We had talked about gold on Friday about really went into extensive look from a price structure standpoint, just looking at simply bar charts and just determining, that this market, its inability to push higher despite a lot of outside market. I wouldn't say outside market, but other markets that would normally push this market up. That being the constant sell-off in gold and in the dollar, although that had been recovering as of lately. But as I said, that come off the basement onto the first floor. It hadn't been like a sustained rally in anyone's imagination whatsoever. Then, of course, interest rates, which are just practically falling through the frickin' roof. And or if I'm falling through the roof, it sounds crazy, but I've fallen through the basement, and still gold couldn't go higher. And I certainly didn't expect this kind of fall. I thought there was potential for us to get down to 1740. That was a level that we've been talking about for over a month ago, when it looked like it was going to possibly turn lower. But those stops were hit, and obviously those are stops that were hit for people that were, as I called them, the hope long positions. But I think these were even more longer term for these people that were saying, "Oh, inflation is going to go here, it's going to go there, all these things are going to happen." And I think that's why you saw such an immeasurable amount of liquidation. Was those medium to longer term positions were also liquidated. That's why we saw this kind of a fall here, and why you'll see markets that'll rotate from what will maybe be construed as a bullish type market. Because I'm not going that far back here, I have to push it even further. Just for the sake of just pulling up the low back in March. But you can see how we had recovered so strongly. Oh, well, it's coming back. I'm telling you, gold is really going to finally break out. And then we fell back, and here's the VWAP off of those lows back in March. And we broke through those, and we talked about, how critical the VWAP is. And not on Friday, but we've talked in the past. For those that are new, relatively new here at ForexAnalytix, we've talked about in the past the importance of VWAP, especially whether it's, and I've even posted the VWAP off of the most recent highs, which are here in crude. Right here. Here's we actually have it right here from a daily. But let me see, I think we have it right here. Yeah, so here's the VWAP off of the highs when we got above, at least in this case, the September crude, above $76. And so here's the VWAP. You can anchor the VWAP, and that's what I've done here. So you can see here how the market, we'd broken higher. Once we broke above it, it looked like it had the potential to move higher, which it did. And then when it came back, this worked as a support. But once we lost that, the door was open for us to move lower. If you're looking at it from a more medium term type of time frame, was generally, for the most of us, we're focused on a very shorter time frame. But you can look at that sense and say, well, I have to be careful. I probably have to go and see other things that will denote that we're going to move higher, i.e. crude, now that we've lost the VWAP. Well, the same thing happened here with gold. We had the VWAP, the volume weighted average price, off of those lows back in March. And you can see how well this was holding this market up. So when we broke here, this is where they found support. Now, the VWAP isn't going to be an area where it stops a market dead on. It can stop a market dead on when it's the daily VWAP. But you can see here that the market broke below. It came back, and you see here where it ran out of gas as we came back to meet the VWAP. And so as long as we're below that, this market is going to remain under pressure. But we held that area. This is that fall back to 1754. When it came to August, that fall was down to 1743 or something, I believe. But anyway, so we moved back to the VWAP. You see here, it struggles. It struggles. That was one of the reasons that over the course of the last month, we kept using as a bias chart resistance 1818, and you can see how well that held. And when we finally broke above it, it looked like, oh, we're finally going to get above, and we're going to get scooting potentially to 1873. But then we slid back But as I showed on Friday, to its credit, for those bulls that were really, long, and unfortunately in this case for them, wrong, were holding out they thought that we were going to revisit these levels here and come back up and really finally break out, because we were seeing inflation across the board, whether it's in energy prices or agriculture, soybeans, corn, wheat, cotton, copper. And they certainly believed it and certainly had something to hang their hat on, although they're hanging their hat on something that's fundamental. And when you can tie in fundamentals with a technical picture, you can have a strong conviction where a market can get going. But if you only have one, if not the other, but more critically, you want to have technicals, because technicals are going to be able to basically combine all the different players and all the different, for those that have some research, have no research, have all the research, they're fund players, they're non-fund, they're big fund, whatever the case may be. That's going to tie it all. That where you can't hide the market overall once you look at the technicals. And so that was what we were talking about. This market was holding up, but every time it kept coming back. And this was really the straw that broke the camel's back. Was we finally get one more breakout, and they sell the hell into this. And I told you that was just on just a 2-hour chart. They gave it, not only did they give it all back, they gave it all back and then some. And then it was a matter of how much further we were going to break. I thought we'd get to 1777, and then potentially we get down to 1740. But problem was they just broke everybody at this point. We've rallied back to the 1754. The reason I stress more, because it's one thing to talk about gold. I wouldn't say it's after the fact, because I've been kind of like downplaying this move up in here for well over 2 weeks, probably almost 3 weeks actually. But we actually focused on this market on Friday and made a dichotomy of a presentation, which is what was happening in Bitcoin as opposed to, and look at Bitcoin. We've already gone up to a foot, and this is actually a resistance level I have in here. We'll look at the Asian analysis. But the dichotomy between these two markets, the reason, and actually I wasn't even in front of the screen, so I thought it was going to be a quiet start to Sunday. I come back and say, what the hell happened? And I saw it's gold, so I started flicking through the Twitter to find out, like, what the hell happened? Well, it was just a liquidation in gold. So when I saw where the Nasdaq futures, and they were actually trading right in here. Actually, they were trading here when I finally saw it. And I'm going to give you some thoughts on this. So we're here, and I was flicking through the Twitter, like, what was it? What was it? Is it something key? And no, it was just the liquidation of gold futures. So I looked at this. I had a couple thoughts. I was like, oh, wow, I missed this move. This is when we broke. Oh, man, just happened to be, as one of the guys was saying, a very quiet Sunday. But it was gold that tripped everything. So I'm thinking, I'm not going to go and try and sell this thing. And maybe it's going to come here and then it's going to rotate lower. But, there's a couple of things that go. One, cash has a necessity to go and still catch up. So I think that they're going to rally it into cash. And another thing I thought of, this has nothing to do, this move that we saw in gold has nothing to do with index futures. It's all about gold being pummeled. And it wasn't like gold got pummeled out of nowhere. We went on Friday and we went into detail. I've spoken before about it, but we went into more detail about how this market just couldn't go any higher, blah, blah. So gold is a key market, but it was of its own self that it broke. And now the media is always going to find a reason why a market breaks. So all of a sudden, they didn't realize it on Friday, but they realized it on Sunday. The Fed might taper. We already talked about that. Fed's not going to taper. They're not going to taper right now. Powell already told you that he's going to give warning way, way, way ahead. If you were to come into Jackson Hole and announce tapering, it'd be twofold. Not only would it shake the market at that time, but also for him to backtrack after saying that they would pounce on him for saying, and it's not because, oh, you said this. No, they would pounce on the fact that he said that there would be a big warning, and then he flipped the script, which the market would then interpret as, wow, the Fed has lost control of this market. They're freaking out. They told us they're going to give us a big heads up, and now they quickly do a 180 1 month later, after saying they would give us, they are out of control right now. They now they feel I have to take action. It would double spook the market. So as I said on Friday, after the non-farm jobs, non-farm payroll, hey, that's a very good number. It was a great number, but they're going to have to see another one before the Fed then starts talking about tapering. But I said on Friday on Twitter, but if the market believes that, we can go and pull back. Well, the indices haven't really pulled back per se, although they broke because of gold. But gold already had a reason to break. It just found that extra inducement. It had already done it technically. This market had gone and broken on Friday. It had been failing. It broke on Friday and even finished at its lows. So it had an inducement to really see some hardcore selling, and that happened. Well, that affected other markets, which in this case was the indices. But my thought was, well, wait a minute. That story is related to gold. That's not, I mean, I'm looking through Twitter thinking, what the hell did I miss? Did something big happen with China or something? I go, no. I go, this is all about gold liquidation. And the market was already weak to start with. I go, these indices, they're going to want to have, they're not going to sell off as much because they're going to want to have cash to catch up. So they're going to have to start off on Monday morning, and we'll probably see a move higher so that the cash has a chance to work off. But once again, has this market been strong? Hell the F yes. This strong market has been strong as an ox. I mean, you'll see my Asian analysis, which I did Sunday morning. I am saying we have to look at the internals, which you never hear me talk about, market breadth, advanced decline, volume that we're seeing. But so I'm questioning how much more than we can see. But look at the dichotomy. This sucker is the biggest piece, and I have not traded gold. Matter of fact, I was almost going to put a position on real quick scalp. I guess I wish I should have. Would have only made a couple of bucks, but I'm just saying this has been the biggest piece of S dog that you've seen. And then look at the dichotomy between these two. Are you effing kidding me? You see what I'm saying? So look at that. So my thought was at the time, I go, oh my God, I hope I'm not going to miss a move because primarily I scalp. I thought, no, you know what? Forget it, because I was going to stay up all night. I was like, you know what? Forget it. I'm just going to go to bed. I'll get up early, and I'm going to see where the hell this thing's at in the morning. But my thoughts are we'll probably have moved higher. Well, I'll be doggone. You see, we moved higher. One of the things is I caught a quick scalp, but I said, wait a minute. And I looked on here. You know my favorite time chart, the 2-hour chart. I'm thinking, wait a minute, what the hell? If we hold 15,077, that's going to be key. And sure enough, and I think probably the have a chance to get the money back, these people. But the problem is the market's going to know these people are short from way down here. So even when we dip back, there's going to be all kinds of covering. But we'll see how much further we can push. Right now, I'd probably say the key level at this point, well, it's 15,077. It's going to be right there, that pivot, 15,098. We might even push a little bit higher. But once again, this had nothing to do with indices. This had to do with gold. I know, but the story was about the Fed taper. Well, we already addressed that. But once again, did this come out of nowhere? No, this market's been a dog since Moses crossed the desert. So that's the reason why. So I'm just trying to put that kind of like put these moves in context. So you can say, okay, well, it might be bad for gold, and you can see here, probably should have stepped in real quick. Like I said, I have been following it in the sense of since this morning. I purposely wanted to get up later so that I wouldn't be swayed by what may have already been happening in the indices. But right now, like I said, even the August gold, the key number was 1752. Well, in DC is 54. Well, we were still at 51, and right now that'd be almost $4. I mean, if I would have just stepped in, I thought about saying, you know what, just do a real quick scalp and thinking, no, I haven't seen how this market's been moving. Don't just jump in and sell it, although this is a pretty good level. Maybe they try and squeeze it a little bit higher. Maybe they try and take it to about 62 or something. Just forego it. Go ahead. But you can see here we're rotating a little bit lower. I haven't looked on here to see, well, where's the fib and all this other stuff. I did try and pull up a profile and then try to pull up the the footprint chart to kind of get an idea of what's kind of on we're seeing over there at 54 to say, are we seeing a whole bunch of people getting stopped out and then or taking on positions, and that'll induce my conviction to go on and short at that point. But you know what, don't just jump in at the last second, just forget it, let it go. But that's where we're at right now, and that just provides I'm no Mr. Know-it-all or something like that. This is something I'd already thought of in the Asian session because I was thinking, oh my God, what the hell? I missed this move. And I'm right here. This is here with the market. I'm like, well, wait a minute. I mean, there's a little bit of resistance. Is it just going to go on and rotate and head back lower? And I'm thinking, wait a minute. Cash is still going to have to catch up. They're not going to push it lower. Like if they do, they do. But the market will still have to rally into cash. And like I told you, I was really flying through Twitter. And I'm like, this has nothing to do with the indices. This is on gold. And that sucker was a dog to start with. So all they've done is manifest a reason why it would happen. And then I saw, I don't know what news store, whatever, then they quote, the Bloomberg article. Wow, you mean like we just realized this on Monday? Not that it's an incorrect narrative, which it is an incorrect narrative, because Powell just told us that he's going to give warning way, 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 way ahead. So if he flips the script, and you know how people like to read the tea leaves of the Fed, if he were to come to Jackson Hole talking about tapering, oh man, this market will flip its wig. It'd be saying, oh my God, and the what do you call them? They call them the bond vigilantes. They'd go bananas. The Fed's lost control of the market. That's why they're having it. They already know what's going to happen. That's why they're doing this right now. They're going to taper because they know this market's out of control. They took a misstep in July. These markets will go bananas. So there's no way he's going to even do it. It's in Jackson Hole. Now, like I said, if we have another, which I said on Friday, if we have another strong payroll report, that's when they'll start to taper. No, that's when they'll start to talk about starting to talk about tapering. So that's where we're at right now. So let's go in and take the quick round around the bush to see where we're at. Some of these markets. And crude oil is at a key level. I don't know if you saw that right there. 65.85 key level. We did break a little bit below, but I've got this other level right there. And you can see this level held here. So I would be, if you were short, I would definitely be tightening those stops up big time. I'm not saying I used to be the kind, I always kiss the falling knife. I kind of learned my lesson now and like to see a market not only come to a level, but find it on a very shorter time frame, trying to hold those levels. And then I try and look at like volume and the footprint to see, are we seeing things that are coming into here on the footprint that is showing that this market's running out of gas? Are we seeing, stops being hit? And so I'll look at different things now as opposed to jumping in so quickly, because even if you do catch the bottom, it isn't like it races off the bottom unless we're trading in a range. It usually sits there and then you make a couple of bucks, then it comes back down, then you're chewing your nails thinking, oh my God, I'm going to take me for more stops. So kind of learn to take a wait, especially in the beginning of a week with everything that's happened. There might be more stops that need to be hit. Not that I think there's a whole lot more. It's just that they're going to wait to see how we open up in the New York Open. Do we see another movement? We probably will see big moves once we get into US Open. But anyway, that's my take. Whether it's wrong or right, that's my take on this, and hopefully trying to put some perspective. And you can see that happening right now in the Nasdaq futures. Look at that. Now they're blowing and going. So everybody that did get short, let's say, just use an example. What if it was me and I said, oh, yeah, I'm afraid this thing's going to turn lower. I better hurry and sell it. I knew the Fed was going to have to do something. I knew all this inflation. And then you're like, okay, well, it's moving a little bit higher. Okay, I'll sell a little bit more. Damn, it's already up to here, 15,069. That was a key level on Friday. I'm just going to hang on. This move is way overdone. And then we keep going. And then, like I said, my favorite time thing, the 2 hour. Oh my God, we're right at the 2 hour. Hopefully we don't close above it. Whew, didn't close. What the hell? Now it's moving even higher. How much further can this go? I mean, I probably never should have added on that position. Let me see, where am I going to put my stops here? And okay, I guess I'll put it right here. The market knows that. So we're probably going to hit up to maybe around, let's see where this level is right there. 15,112. You see what I'm saying? The higher pushes, some of these people are going to get stopped out. And those that do hang on, and when the market comes back later on, then they'll be looking to cover on moves down here. So you kind of have to figure out where these markets are at and try and put them. I mean, I think you have to, like in a lot of these moves, and that's why I quickly went through Twitter to kind of look at things. You have to put things in. I think it helps is, I saw something was saying, I think it was Jedi Marcus was saying something about his things, and there's one that he says it's something about nothing's impossible, only improbable. And I think what you have to do is when you see moves like this, you have to say, okay, where is my thing if this is a okay move? Where's my thing if it's a bigger move? What if this is my thing where it's an outsized move? And what I mean by that is, what are my levels now? If this is an outside move, wow, I'm looking at down here at 14,960. And what about if we get down to 14,923? You see what I'm saying? You start to look in that and say, yes, this is a much bigger move. The same thing, a good example would have been with gold. Wow, it is even breaking past 1740. Where are my big levels? Let me get to my daily. Let me pull out a 2-hour chart going back to, like I said, the beginning of the year. Let me see what these levels are. And remember, if you remember, 1680 was a big level when August came down there. So they did overshoot that, and then they found some support. And then we started to take off, and we are where we're at now. And they probably will rotate lower, a little bit lower from the 1754. But you know that even if it was like, oh, this market was overdone, they still have to come down here and do some homework, or what I call construction work. So we'd have to come back down to 1720, test the stops below, see if there's any feelers there. If there's not, then the market would probably rotate back up to around 45, maybe 40, and then we have to do some more work, and then the market would find out, are there any more sellers? If not, then we'll have to go in and same example that Blake has talked about. When you fall off a ladder, you just don't jump up. If you fall off from a decent sized ladder, you kind of sit there and think, okay, am I okay? Where's the pain from my broken bones or whatever? So that's what happens. This market's going to come down here and have to do some homework. I haven't traded gold very actively in a long time. So, but I would say that from a technical standpoint, that's what would have to happen. Because people that got knocked out of their bullish position, they're not about to say, okay, now I'm going to get back in. You see what I'm saying? And those that may have shorted or whatever, they may have covered, and there's like, well, I'm going to wait because the market's truly overdone. And it'll be just a push and pull back and forth that we rotate lower down here. But anyway, enough of that. We might as well just jump into the analysis at this point. So let's pull out the old bias chart. But I thought it was important to provide some context. It's one thing for someone to come on here and say, oh, well, we talked about gold. I told you it was going to go lower, it was weaker, blah, 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 beat our chest. All that stuff doesn't matter at this point. Now, the market is where it is now, and then you see where we go from here. Just like I told you about Nasdaq, I will say that. I said, oh, my God, I missed this whole move. What the hell happened? Then I'm like, okay, wait a minute. Okay, before you jump into something, where are we at? What is the context of the move here? Now, like I said, there are concerns, as I told you, about market internals, but this isn't going to happen over a weekend unless something huge that would have changed something. Had the Fed come in and stepped in and done something, that would change the whole outlook, and you'd have to reset everything. But if not, then we're probably going to make a counter move back, allow cash to come in, and then we'll see what's really behind this move. So that's where we're at now. So anyway, let's go and move into the euro dollar. And honestly, that's where experience comes into place, into place where you don't overreact to something, or you take things into consideration, and more importantly, put them in context. So let's go on and move into the euro dollar and see where the heck we're at. Well, lo and behold, we made it to our 1748. There you go. Finally, we made it. For those that are relatively new, we had been looking for 1748 over a month ago. That's when we were looking for it then. And we missed it by 3 pips. And I had been looking for 1748. At that time, the markets kept sliding. So I'd already said, look, I'm not going to make these bias charts where it's just 10 pips, 15 pips. We're going to 1748. Then that's that. And I said the same thing with the Aussie. We're going to 72.87, and that's that. That's where we're going. I don't care what blah, blah, blah. Well, the low was 72.89. Was it 73.89? Whatever it was. And the Aussie would have been, it was 72.89, I think it was. We'll go back. Let's go back to the Aussie just to go on and get the clarity on that. There we go. And there was our 72. Then we've moved it now to 72.59, but our weekly at the time was 72.89. And I was like, I don't care what's going to happen. I'm telling you right now, it's going to 72.89, 72.87. Turned out the low. We missed the low by 2 pips. 72.89 was the low at the time. And then you can see where with the euro, we had 17.48. At the time, it's the same play we were talking about with the Aussie, and I said, I don't care what's happening. We're going to 17.48, and we stopped at 17.41. We missed it by 3 pips. Nothing great I'm doing. I'm just saying I'm going with the level. So all you can do, you can use your monkey indicators and your oscillators from the oscillator of the oscillator. You trade the freaking levels, and that's what you need to go with, okay? Once again, I don't want to sound like I'm whatever, come off the wrong way, but like, believe me, I've used every tool in the toolbox, and so many of these tools aren't worth a doggone. Look, stick to the levels and stick to looking at a chart. And instead of putting up an oscillator because you don't know how to figure out what a chart's doing, study the chart. And when you will study the charts and you study the movement in front of and do screen time, you will begin to see the movement. You'll actually sense the movement as it's playing out and saying, wow, no one knows for sure where market is going to go, but you can sense, oh, wow, it does look like it's slipping. You don't need an oscillator to tell you it's running out of gas here. And when you start to do that and you use that in connection with your other indicators, you'll have a better idea of how these markets go. I mean, like I said, look, I'm not here to pat myself on the back, but I will tell you, like I said, miss this sucker by 3 ticks, miss the Aussie by 2 ticks, miss the Bitcoin by $99. Like I said, take, how do you like them apples? But you know what? It's all on the levels. There isn't any special oscillators that I'm using. So anyway, enough of that. We're just going to move into the analysis right now. But that's what I'm saying is, my point is, and it's not anything about me, I'm just saying that you have to learn all these stupid oscillators and things like that, which are simply derivatives of price, is not necessary. If you break things down, you'll start to see, wow, I think this is where the market may run out of gas. Everything's a probability. There's no guarantees on anything, but you basically use the different tools or I wouldn't say, when anyone say analysis, you just use the structure of these markets, the different levels where they go through the bodies and how these markets are reacting. Then you look at it on a daily and you look at it on a weekly. That will give you indications where these markets are going to go to. I would look at these markets and I'm like, how do they know it's going to stop there? Well, this is crazy. I looked at my RSI and it did this, and we're like, no, that doesn't mean a hill of beans. And for the most part, moving averages don't make that much difference either, which are simply derivatives of price. They do make a difference on longer time frames if you're looking at a 50-day moving average or a 200-day moving average, but for the most part they don't. So anyway, enough of that. Let's go on and move on. But because there's so many new people that we do have, I did want to go into some detail as to what I'm referring to, and it's nothing great I'm doing. I'm just simply going with the levels, and I found that if you just go with the levels and you learn by viewing and providing ample screen time, the structure, price structure, not necessarily that you don't have to be a profile person, but the price structure of these bar charts. We talked about them at length, maybe ad nauseum with the gold, and you can see that and you can say, wait a minute, this market just can't go any higher. Look at it, up, then down, up, then down, up, then down a lot. Then they break it higher, they come back, and okay, it looks like we're back on our way. Wait a minute, now we got a gravestone judge. That already tells you this market's in trouble. So you don't want to be buying this sucker. So anyway, enough of that. So the euro finished Friday just ahead of the key weekly support of 1748. Bears are going to push for the stops below. Support will be 1713 with a resistance of 1835. So they did barely push above this, but what I'm looking at is what's the tone or the set for the week ahead. So if we do see the pullback, although we already started to see with gold, I think that probably kind of threw some things off. But I thought we may have seen indices run out of gas had it not been for gold on a push higher on Monday, maybe Tuesday, and then we slide, and then potentially this is the next area. So our 1748 has worked. Actually, it looks like the low might have been, let me take a look what the low was. 1742, not bad. But I'm looking at for the week ahead. So it's going to be 1713. That's what we're looking at for the week ahead. and resistance is 1835. Obviously bearish. Now let's go move into cable. $38.59 had been key for us. I put it down to $38.38 on NFP day to give it some extra room, but I think we've moved a little bit lower towards there now. But that $38.59 actually held to the pip on Friday. Once again, all about the levels. Keep telling you, all about the levels. You keep using whatever you want, but I'm just telling you, if you focus on the levels, you'll increase your opportunities. So the cable posted a bearish engulfing daily bar on Friday. You see that? And I go with the bodies. I don't give a you know what regarding these wicks. It's all about the bodies because that's what counts. So someone might look and say, that's not an bearish engulfing. I don't care about the wicks. Okay, that really happens when you encompass the entire range. That's huge. Then you can see right here, essentially almost, but wasn't quite a bearish engulfing. This one did engulf the entire previous day's body, which opened the door for us to lean lower. So if you're going to have that, you know there's going to be stops to push. So even if you're bullish, you definitely would have wanted to wait. And if you're bearish, you know that they're going to try and push a little bit lower. So cable posted a bearish engulfing daily bar on Friday. Bears will attempt to lean on the stops to start the week. Support will be 38.13 with an overall target on a break leading to 37.59. Here's my 37.59 right there. Resistance will be 39.41. So here we've got 38.13. And the upside 39.41. And like I said, I apologize if it sounds like I'm coming off as a know-it-all, and that's not the case. I'm just saying is if you just focus just on these charts, the flow of these bar charts, the levels, you don't need a whole lot of other stuff. Unless you're trying to, I see these people talking about, oh, this market can go here. Who cares? It doesn't make a difference whether this market is going to go to the next 3 or 4 months, unless you're a portfolio manager or you're hedging for a big corporation. I mean, we're here to go and make money on these shorter term time frames. I don't even have to be a day trader, but what the hell does it mean? Like the cable may go to 150, it may go to 128. Yeah, what the hell happens in the meantime? Let's go and move into the Aussie, which is another market. And it's just silly. Just go with the way these markets are trading. You might end up being right eventually, but what good does it do if your account's been up and down, like crazy in the meantime? It just doesn't make any sense. Just go with what's being traded, how the market's being traded. So let's go and move into the Aussie dollar. So the Aussie Bears reimposed their will as the market challenged the key weekly level last week of 74.27. And we'd actually given it, we'd been using 74.27 for a long time, but because of NFP day and the ability to, not the ability, but generally you see there's a lot of this wild volatility, we gave it some room to go in and take out above the highs, which we then moved it to 74.43 just in case. So the Aussie Bears reimposed their will as the market challenged the key weekly level 74.27. A break lower points us to 72.59 as a target, which will now be support. Resistance will be 73.95. Once again, these levels are not necessarily for today, which they could be, but no, what I'm doing now is on Mondays, we like to set the tone for what we're looking at for the outlook for the week. So bear with me. Now let's go and move into the dollar yen. So dollar yen reasserted its strength on the weekly chart with a solid rebound after dipping to sub 109. Key resistance for the week will be 1055, followed by 1097. Support will be 962. Once again, we're laying out the ranges for the week, at least as we see them on Monday. So we're looking at 1055. And if this market were to roll over, because we definitely don't know what can happen with the market, the key area right now would be 962. We'll find support well before 962, but what are we looking at the beginning of the week? Now let's go and move into the cash dollar index. And you can see here this move that we got here, and on Friday, look where the market stopped, 92.83. Where's the bias chart? 92.83. Does it have anything to do like, oh, I called this level? No, it didn't have a damn thing to do with that. It has to do with the levels. So, I mean, I don't know how many times I can try and get it to people's freaking skulls. Look at the levels, okay? That's what these markets react to. They react to the levels. They don't react to, all these crazy technical indicators. They react to the level, and sure enough, resistance on Friday was 92.83. Where'd the market go to? 92.83. So let's go and take a look at. So the dollar rebounded the prior week to finish a hair below the resistance level of 92.83. Key levels above remained the same from the last visit. That will be 93.26 and 93.53. Support will be 92.38. And look at what you call Nasdaq. Look at that. People just getting mowed over. And not because I know, you know what? I've been there. I've been in this boat before and thinking, wait a minute, how can it go rally higher? And so, like I said, the stuff I try and share is not because I'm Mr. Know-It-All or whatever. No, I try and share the stuff from the mistakes I've made. So resistance now, the key resistance, if we're able to break higher, is going to be back to the old 93.26 and 92.38. Now let's go move into Bitcoin. So Bitcoin broke higher Thursday, running stops up to 41,000. The coin is posed to break higher. Resistance for the upside break is 41.6. And I don't think that captured Sundays. Hang on a moment. Oh God, this always does this. Maybe that was Sunday's analysis. I don't remember. No, it wasn't. Doggone it. Sorry, excuse my language. Okay, here's the analysis. I don't know why that happens all the time. Freaking TOS. So Bitcoin has continued its breakout rally into resistance level 42,708. There's a small zone between, oh yeah, and I had the daily, so hang on, let me show you. There you go. Doggone it. There we go. So Bitcoin broke higher on Thursday, running stops up to 41,000. Doggone it. So Bitcoin has continued its breakout rally into resistance level of 42,708. There's a 42,708. There's a small zone between 42.7. I'm going to put the 8 right there. Put that. To 44,519. You see that? Wow, it actually hit it to the dollar amount. Holy smokes. The market is likely to find offers into this zone that will have the market pare back for construction work. Immediate resistance is going to be 43,588, followed by 44,519. And it looks like that's what stopped the market. Not bad. Once again, it sounds like a broken record, but all about the levels. Support's going to be 41,400. And if you look at this, try and open it up a little bit. There you go. There's what I came up with it. I usually try and go with the bodies, but I'm like, okay, well, now we're gapping higher. What do I see up in here? I don't see any above bodies. I mean, could it push up into here or here? Well, if we're gunning stops, we're probably going to go for a previous high-low. And that's how I came up with that, 44,519. And it looks like they took it out by just a little bit. They did. The high was 44,756. Holy smokes. Made it up that high? We doggone. So it did. So it went out, still went out about an extra $250. But you can see right here, now we've pared back from that level down to 43,900. We can see what it looked like. Up there, 15. Can't say there was anything definitive. Yeah, that was a key level, but I'm saying this like, did we see something bigger like Gravestone Doji or something? Not really. I mean, that wick's too short. So we just came to that level and we just found offers and we just started to ease back. That's it. Let's go and move into the S&Ps. This analysis is done, like I said, I call it the Asian session update because I updated generally during the Asian session. Sometimes a little bit later, sometimes a little bit earlier, but on the weekends I updated on Sunday morning. SPX futures closed at another all-time high. Levels above are, let's go back to here to the daily. Levels above are simply mile markers. Immediate resistance is going to be 44.50, followed by 44.82. Keep an eye on the market internals, volume on SPYs, breadth, advanced decline to determine the strength of this rally. Support will be 44.12, followed by 43.96. You can see they almost made it to, oh wow, look at that. What do you know, folks? Look at that, 44.1175. Once again, this is a key level, that 44.12 though, because I came up with that. So anyway, another hat tip to the levels. We'll go 44.50. Nasdaq is now above 15,100. Can you imagine the people that shorted down there? They are in some hurt, and the market knows it. 44.50. So bullish. Now let's go move into Nasdaq. I think we probably see some, like I told you, if you look here, probably 15,111. Let's take a look here. Here's 15,108. That was Friday's opening range low. Opening range high is 15,122. Let's see. Here's yesterday's Friday's opening range low, 15,108. There's some pretty key volume right there. You see how wide that one is? 15,108. You see that? Of course, that was the open. Now the opening range, not the opening range, the volume area low on Thursday was 15,114. Call it 15,115. So there's a confluence between 115 and 122, and the volume, the value area high was 15,120. So you got 120, 122, and 115. So they may try and, my guess is right here, I might take a little scalp against that 122 area. Let's see if they can, how much further they can blow. Because at this point, then you have to figure, even if they go higher, we'll probably have to come back lower to retest. So I'll probably take a little flyer there. You can see here the key volume on Thursday, volume level was 15,147. I'm gonna see if we can take out 122, maybe by just like a hair. That's probably where some people are going to be saying, I've got my stops at 15,100. I've got my stops at 15,110. I've got my stops at 15,120. So maybe we can even scoot up here to like around 125-ish. Just take out the opening range high. So let's, and we can take a look at the profile. Nothing there. Let's go to RTH. Okay, so RTH 15,112, value area high on Friday, value area low on Thursday 15,128, initial balance high on Thursday 15,133. So I'll look for a move potentially around the 15,120, 125. I think in that area, I don't mind taking a flyer there, because even if we scoot up, they'll probably have to come back down to do some homework. I might take a flyer there on so let's say 15,000. Let's go with 120. And support. You see here, we've got a point of control here, and we have the value area low there. And remember I told you on Sunday they were having some trouble there, so I like this area here. If, let's call it right there, 15. Don't see it necessarily breaking that low. It can, yeah, let's go with that. Let's call it 15,021. Now let's go to gold. Okay, well, we already know what happened with gold. We have to look at that big daily level. And we know from August that was 15,068. So, I mean, what you call it? Well, let's pull it up. 1680. That was at the level of the August. We can actually, let's pull it up. Well, we're looking at gold. Let me see. Let's pull it up this way. That will give us the continuous futures. Okay, there's continuous futures. And so back in March, this was key right there. You see that? See where I'm going with the bodies? And that would have been, and let's just say it's right here, but I mean, we already know it's 1680, but let's just say 1686. Don't want to make it look like I was here calling the bottom, which wasn't, but if you were breaking that, that's what you'd be looking at for the different areas that could have stopped at. So 1686. And right now, resistance is 1754. And we're now bearish. And let's take a look at crude. You can see here on a daily, look at this. $65.24. So crude oil finished at the lows of the week. Bears on a break will be targeting 65.24 with immediate resistance at 66.68. Well, no, the support would have been 60. Immediate support would be 66.68, and they're targeting 65.24. So looks like they're heading down there. Now they can overshoot it, but that's what they'll be looking. You can see it's a pretty big, huge key level. Resistance will be, well, it's not going to be 68.60 anymore. Let's go and put this here. Watch this. Let's put this on crude. Put it on the footprint chart. Go to process. May overshoot it, but that's where the levels are at. Put in here. the upside. Let's take a look. 66.15. But if we do overshoot, this is gonna be a pivot, 66.43. So there we go. And there's the bias chart. And that's it. And I'll get that posted into the room. And thanks for joining us here on the European Crossover webinar.